Welcome back to Wall Street Beats. It's September 9, 2024. We're here to give you some great intel. I have some esteemed colleagues with me, including Russell Young, Verna Barchet, Jeff Mackey, Ben Bry, and Stephen the Push Lamar. So without further ado, let's start with Ben. He has some macro stuff to share that will curl your hair, and not in a good way.
Morning, Paul. Morning, guys. Yes, we had a discussion last week on the Wall Street Beats chat. We had a bad week last week, probably the worst week in the markets in a couple of years, where we went down every day consistently and all rallies were sold. So I just wanted to think about where we are versus where we've been. There's this saying of like, you don't know where you're going to go if you don't know where you've been. And so when we look at the S&P, you can pull up this first chart that Goldman put out. And we're looking at the percentiles of next 12 months PE ratios for the S&P, the equal S&P, what we like to call the other 493, in the NASDAQ and the Magnificent Seven. And you can see that we're in the upper quintile for everything. So there's not really like a case for the market to be cheap on a forward basis, but it's not at the extremes. And then if you go to the next chart, you can see the historical time series of these. The top one is the next 12 months PE, again, estimate, but the bottom two are realized, right? So trailing 12 months price to sales is in blue, and EV to EBITDA for the S&P is in orange. What you can see is we're 2 standard deviations above the trend over the last 40 years. And so what does this mean? This means that you have to, if you're going to be bullish and you're going to be excited about stocks here, you got to be thinking that there's going to be growth. And so if you go to the next chart, what you can see is essentially, it explains a lot, right? You see that the Mag 7 has really been the source of all earnings growth for this market, and capital chases growth, and thus we had the market become extremely concentrated to the point where the top 10 stocks are like 35% of the market. What's interesting now is that we're seeing some convergence on expectations for forward earnings growth, with the Mag 7 decelerating and the rest of the market, the other 493, if you will, coming up. And we've seen some action in the markets that actually show that, where the Mag 7's kind of been a little bit flat to down and winners have been flat to down recently, whereas some of the laggards have actually started to pick up a little bit. So I think this is being reflected in stock prices. The thing that you got to think about here is we're not going to get 50 basis points as the market really was hoping for based on the jobs number. It was trending down. Full-time jobs were minus 300,000 versus 500,000 part-time, but it's just not enough to force the Fed to do 50 basis points. So there is a risk here as we go into the blackout period for the Fed, and as buybacks taper a little bit, that we could have a fairly weak September here. And if you go to the next chart, you can see that that's the historic norm. You see the 1 month, this is the last 30-year average, and you see the 1 month that really just sticks out is September, with an average return at negative 81 basis points. And so partially that's because we have the end of the fiscal year for the government. We have the end of the fiscal year for old firms like my old firm Fidelity and T. Rowe Price and Capital and some of these big mutual funds. So there's tax loss selling that goes on. And then also we have the uncertainty around the election and some of the geopolitical things. So I think one of my takeaway here is that there is a risk that we gap down because the actual earnings per share of the S&P is only $200 and it's been flat for 2 years. So that means on a trailing 12-month basis, the market's at 27 times, which is not cheap, right? For a broad index, that is a very high number. And so for you to be constructive here, you really need to like have some of this growth come in, or at least not have the expectations of growth decline. I think some of what's gone on recently is that we've had what you call maybe a growth scare. And so the expectations are being revised down, and expectations are reality when it comes to markets.
Ben, you're absolutely right. I follow some of the Edward Yardeni numbers for the S&P 500. And one of the things that I actually was surprised by that, the estimates for not the tech sector that I follow, but for broadly for the S&P 500, I thought those EPS growth estimates were a little bit outlandish on the upside. So there might even be some exaggeration there, and that could lead to further disappointment.
Yeah, I think that, you really have to feel good about what you're owning here. And so one of the reasons why maybe the more beat up stocks that are still stable, not the Dollar Generals, but the Starbuckses and the McDonald's and my British Tobacco and some of these businesses that have traded okay recently, is because the multiple got re-rated and they're stable businesses. Yeah, maybe they're not great, but it's not like they're going to the woodshed the way some of the weaker ones are. And I think that's kind of what's going on right now.
I agree. I've seen it in my own sector, sometimes disappointingly. So anything else you want to share, Ben, before we move on?
I just think that right now we're just at a fragile time. I think, a lot of people got very complacent that they could hedge their books as volatility was very cheap for a while. But now that we've had volatility come up quite a bit recently, and the skew of the market, as Imran talked about last week on the show, it becomes much more expensive to hedge your book. And so the option dealers right now are in a negative gamma situation, which means they trade with the market. So I think we have rising volatility and less liquidity, and that's something to be aware of as we come in here. So there is going to be potential for fading rallies and buying dips for the traders. And I think for the people who are investors, just be aware that it's not going to be as smooth sailing as it was in the first half of the year.
Yeah. Hey, Ben, thanks for the insight. And also thanks for the graphical evidence. It's always really cool. Let's move on to...
Hey, Ben, quick question for Ben. Ben, if you want to hedge this here, is the best way to do it, is if you want to hedge your basket, your portfolio, is the best way to do it with maybe put spreads, or just use the indexes as a way to short it? Or how do you protect given that volatility
are
so
actually
high?
better than they were. I wouldn't have used put spreads before August 5th, or maybe a little bit in August, but like not as much, because now the farther you go out the curve on the left side for puts, the more expensive they are on a unit of vol basis. So that is okay. But again, equity vol is expensive. Last week I talked on Monday about using credit. Credit spreads are very narrow. So if you're worried about the credit cycle, that's the cheapest way on a historical basis to do it. And then, but always Delta 1 is pretty easy, right? Because you can trade S&P futures 23 hours of the day. So, and they're pretty liquid. I mean, maybe if you're a huge player, they're not as liquid as they used to be, but for almost everybody else, they're liquid. So you can manage your exposure pretty easily via that.
Okay.
All right, let's move on to Jeff Mackey, who I finally call, what do I call you, Jeff? The third rail of consumer.
The third rail. Yeah. Because I'm electric and I don't like being peed on.
And you also have some retail investment themes that are contrarian. So I'm chomping at the bit to hear about it.
I don't know how contrarian they are. It echoes what Ben says and what we're talking about here. We got a lot of headwinds. And so we haven't seen tremendous reaction to the news. Any kind of gray guidance has just gotten winners absolutely destroyed. And we're seeing a lot of clumping. The street is clumping into various themes. I'm looking at, in my sector, that's going to be Walmart and Costco, which they are my macro analysis. For whatever reason, people decided Walmart was just the bee's knees this year. They're having an absolute monster year. And Costco is as well. Now, these are really huge companies. They reflect more America in general than they do any sort of downtrodden America. If you look at how those stocks are performing compared to, say, a Target, a Five Below, Dollar General, anything with dollar in it, those are down 45% on average, just that basket I picked. It really isn't that hard to find a basket once you get away from sort of the TJ Maxx's, the Walmart, the Costco, these real simple themes, these companies that should do well in a decent economy, or, in a flagging economy, rather. That's where everyone's going. And to me, that makes me a little nervous, because these things are going to take the absolute kind of elevator shaft down once they break, because it's really hard without the earnings growing. And if you look at how the earnings have grown in Costco and Walmart, it's really been a story of multiple expansion rather than a fundamental case. That's going to be thin gruel, as they say, if you believe that September is not going to be a great year in the market. And you could also see the same basic trend happening if you look at NVIDIA and Abercrombie and Fitch. Abercrombie and Fitch, I obviously cover it closely. NVIDIA, I'm not sure what kind of pants they make, but they've had a chart that looks almost exactly like Abercrombie over the last 3 years. I mean, there's no reason that these companies should be visually or really otherwise correlated. they're just in wildly different industries. But you're seeing that same reaction. Those, see if you can guess where they reported. Well, it's that last spiky point right before their stocks went straight to hell. They're both already kind of in bear markets. That tells me that the ideas that worked at the beginning of this year, and no stocks have been hotter for the last year and a half, 2 years, than Abercrombie and Nvidia, one of which gets talked about a lot, and others just kind of for me. But when they start to act in tandem that way, it's a bad moon rising as far as I'm concerned. So what I'm doing is treating it in a seasonal way. I'm making a list and checking them twice for stuff I want to buy right now that's not going to get me killed, because simply for the most part, it's already been beaten up. Starting with a name like Target, which has been left for dead. If you compare it to Costco and Walmart, you draw a Venn diagram, you're going to get a lot of the same cluster of people in overlapping groups. Target simply, they're not as good. They're not the company that Walmart and Costco are. They're, at least in terms of their growth potential and the cash flows they have income and otherwise. But that's a great looking inverse head and shoulders chart. I love the base they're building. And I really like the fact that Target, while it is no Walmart, isn't this much worse than Walmart. That tells me that people are just kind of giving up and they're getting crowded into those last year's favorites. I want to belong next year's favorites. Best Buy, another one. They reported and surprised and did great, but there's no rush here because, again, now we're going into, just like buybacks, and we're into the dead zone of news. And Best Buy just reported, and so now we get to fret for another 2 months over whether or not anyone's going to buy electronics again. I like Best Buy as it consolidates into the 90s. And finally, in this kind of triple crown of boring, disappointing, and long-time beleaguered companies, I still like Gap. I like Gap pulling back. They're down almost 20% from reporting yet another beat, yet another really pretty decent guidance. Expectations aren't huge. The multiple's not huge. They're just simply the Gap, which is reason enough, actually, to be chillingly disappointing, because they've gone through the last 5-10 years of being disappointing. But I think this new guy's he's on the right track anyway. That's good enough for a 15 multiple store that people have given up on. I think you can close 300 stores and see that stock go up $2 right away. I think you can chop it up. I mean, there's just a lot of scenarios, a lot of ways they can win. And that's my list. I don't think there's a huge rush on any of this stuff because, I'm afraid about debates tomorrow night. I really don't want my equity positions to be impacted by crap that comes out of politicians' mouths when markets aren't even open.
And that's coming for sure. So of the three
right there.
we're thinking about, Jeff, Target is a little bit higher urgency than the others?
Urgency is a really strong word. It's you look at Dick's, that was a classic sell the news type of situation. That you only lost about 5% there, so it wasn't a catastrophe. So, and that's sort of your best case scenario. That was a beat. That was a great number. Best Buy, it didn't run away from you, even though that was a really surprising number. People expected terrible things out of them. So I think that any prices that you get here, you're going to get another shot at them. I mean, if you bought in mid-August thinking, I didn't get the August lows, but I still have a pretty good price here. Well, you're getting the August lows again in a lot of these stocks. Only this time you don't have the volatility spiking, so it doesn't scream intraday, one-day huge reversal the way you get, a 50 VIX might.
Well, even if you take a look at that technical analysis you showed for a Target, the reverse head and shoulder, it looks like it needs to break out of the shoulder. I'm no
you can let it break.
Rule, right?
That's exactly the point. You let it break. You set a stop on it. You're looking at it's if these were things that I was buying this afternoon, that would be kind of silly actually, because Best Buy is not even over where you're the specific line you're pointing at. But if you put a stop on them, you start thinking about where you would like to buy them. I want to buy Target when it gets to the lower end of that shoulder. That's where I want to buy it. And then if it breaks from there, I've got a nice place to sell, as opposed to just buying and hoping that it breaks above the other side. If I'm not going to get long Best Buy and hope that it gets to 105 so it has a clear breakout, because it's not the season for hoping.
Well, thank you, sir. Let's stick with retail here. Berna has some interesting thoughts. Academy Sports, Petco, Dave & Buster's, and a way to go to the movies with Disney. So please.
So you would think earnings would be over. We were talking about the end of earnings palooza, but somehow it's, we're closing on in the middle of September and we're still getting second quarter results from the laggards of the group. So we have Academy Sports, Petco, and Dave & Buster's all reporting tomorrow, Academy before the open, and the other two after the close. These are, kind of down and out stocks. I admit, I own all three of them. Academy has been a huge winner for me, even though it's down a lot this year, because I bought it right after the IPO in October of 2020 when it IPO'd at 13-ish, and it's around 55 now. It had been around 70, I think, at the highs. So it's down a lot, but, also up a lot on the longer term. Woof is, a bankruptcy, flirting with bankruptcy, but has time to turn itself around. And Dave & Buster's an interesting one because it was up 25% to start the year off of kind of a hot presentation at ICR, and is now down 40% on the year. So that's been more than cut in half in just a few months. So in terms of a recent 1-year chart, all these guys are down and out, which makes for, it sort of makes for what Jeff was talking about. Maybe they've been de-risked. I'm not sure because I'm not expecting a great quarter out of any of these. Like Academy, you would say, hey, Dick's had great numbers. Dick sold off because it's has a chart that's been up and to the right. Maybe Academy will benefit from this. I'm not holding my breath that Academy is going to look like Dick's for two reasons. One, it has a higher weighting to lower income consumers than Dick's does. And we know that that's been death for all these retailers. But the other thing is, I think, the sort of wind under Dick's sails has been their, on running and Hoka exposure, which Academy doesn't have. So I'm expecting a pretty rough quarter out of them, but I'm going to be listening closely for any comments that they have on the footwear sector, because one, I think we might get some clues about Nike, reading the, between the lines on what they say. And then also, they're clearly trying to get On and Hoka into the store, and that would be a huge rush for them if they got it. And the other thing I always listen for on this company is capital allocation, because these guys have been, in my opinion, they're the new AutoZone in the sense of being just great capital allocators and pushing their stock price through generating cash flow while growing, and then just, plowing it back into the balance sheet. So these guys have taken down debt a ton. They IPO'd as, a private equity backed vehicle. Debt's down a ton. They've reduced their share count in 4 years, less than 4 years, by about 20%. So be watching that. Petco, this is the low dollar lottery ticket that I've talked about before. It's trading around 3. It's been in a range of 1 to 4 this year. This is the first call for the new CEO. One of the reasons it got to 1 is the old CEO, and he got kicked to the curb in July. So we have Joel Anderson, who's coming in from Five Below. Oops, there goes my dog. He's coming in. It's his first quarter. I would expect a guide down here, because if I was coming in as a CEO in an uncertain macro environment, why wouldn't I, guide down? Sorry, I have construction right outside my apartment today.
Your dog's a fan of the CEO you're bashing.
And then finally, Dave & Buster's. This is really interesting because this stock is sitting at a really interesting level. It's just above 30. If you go back to 2015, ignoring the pandemic shutdown period, it's barely traded under 30 in the last 9 years. So talk about like an interesting support level. This is a very cheap stock. It's also in a turnaround. The one thing I noticed here going into the quarter is that the short interest has gone from 23% of the float to 11% of the float in the last few months. Now, there's two possible explanations. One is that the people who were short, and were right, by the way, realize that, it's really just too cheap to be short now, which is like a good sign that maybe this is a good place to be buying. Or you could have the opposite, that sort of a less so bullishly fundamental explanation that, the people who have gotten blown up in some of these declines in things like Elf and Abercrombie and such, if they need to stay market neutral, they need to cover their shorts as their longs have been going down the last few weeks. So, you can look at it, but it's pretty interesting to see a stock, have its short interests have pretty quickly like that. These are all cheap stocks. I'm not excited about the quarter for any of them, but if they don't go down, that may be good, all clear signs. And then the other thing, real quick, I just wanted to mention huge box office for Beetlejuice this weekend. 36 years in the making, that sequel for Warner Brothers. I haven't seen the movie, can't comment on whether or not it's good, but it is really weird to see the third biggest opening of the year for a movie the first weekend after Labor Day. This is also NFL weekend, so the ability to bring that many people into theaters on NFL opening weekend is crazy. I think that it speaks to the fact that movie going is a habit, and one that we got out of during the pandemic. We had a much stronger summer slate and kind of the best run of movies that we've had for 3 months that we've had like since the pandemic, where we've just had one good film and then nothing to follow it, partially because of the strikes. So I think that's good news. I don't think you buy Warner Brothers on this. They're still under a mountain of debt, and I don't trust their management team at all. But looking ahead, Disney has 12 films next year versus the 5 they had this year. They have some very strong titles, including Avatar and Zootopia sequels next year. So, I've said a million times, under 90, because of the parks business, you're paying so little for the studio and linear TV business. Once you get below 90, that I think that's a good place to take a shot at it. Well, I think, coming off this, having the 2 biggest movies of the year this summer, which will, pay dividends, for quarters to come. And then looking at the fact that I think that, the last sector to come back from the pandemic may finally be getting a little healthier. That's a nice setup for Disney.
Yeah, it blows me away, the box office this weekend for all the reasons that you mentioned.
Yeah, it's just insane. Yeah.
So we're going to finish up here, going back to my tech sector compadre, Russell Young. You're going to talk to us about Guidewire today, from what I understand.
Yeah, no, like when I listen to what everyone's saying, right? Ben starts off like it's an uncertain macro environment, and Jeff and Bernard are telling you that it's a stock picker's market, right? There's plenty of stocks at highs and plenty at lows. And so when everyone's focused on macro and is nervous about the market, I like to say, like, what companies are beating, who's doing well, who's getting overlooked because the environment's so scary. And in an uncertain market, growth goes to the head of the class because investors want things that are growing. They need to invest, and they're looking for the very best companies. And so that's what I'm looking for right now. And the most impressive call I listened to last week was from Guidewire. Guidewire is an insurance platform company. So they make software so you can take old legacy insurance software. A lot of this stuff is 20 to 40 years old. It's written in old, outdated software, and it needs to be upgraded. It needs to be brought to the cloud. So Guidewire is about $160 stock. It trades at a $13.5 billion enterprise value, which comes out to about 10 times current year sales. It's a July fiscal year end. So it's expensive, and that's going to be the holdback, and that's why analysts don't have aggressive targets on it. But when you go through the call and you see what's going on, is this business is about ready to massively inflect to the positive in terms of how much they're earning. Their gross margins have gone from the mid-50s to 65%, and their target is about 75%. And I think they're going to be there within 2 years. And so when you look at what's happening in the business, is their ARR was steady at about a 15% rate, and last quarter it's jumped up to a 19% rate. And then when you look at what's happening with their insurance suite customers, is that business is just really accelerating. The last 3 quarters, it's gone from up 52 to up 28 to up 37%. So the business is massively accelerating to the positive. And I think you can buy this business for about 20 times the fiscal 27 year operating profit. So I think this is one to take a look at. I think this is about ready to show some the industry is establishing itself on Guidewire. This is a huge market, and I think this is a really interesting stock.
Now, who would you compare it to? You mentioned a price to sales multiple. Who would you compare it to, at least in the States?
You have other companies like Duck Creek that also do this business, but what you're seeing with Guidewire is it's becoming, everyone is moving to their platform. And the fact that everyone, as other software companies, are complaining about a challenging spend environment, like their deals are not getting postponed, their deals are getting accelerated. And what's so interesting about insurance is, what is insurance, but you're trying to predict what's going to happen, okay? And that's how you set your rates. What is AI great at? It's great at being, helping you do better predictions. And so the insurance industry could go through a massive evaluation of its platforms, knowing that you're going to have to take AI and better software to better predict what's going to happen. So this is an industry that's going to be enabled by AI. And so trying to compare it to other things that aren't as predictive, I think is dangerous. I think that's what the street's trying to do. So I think this is really a business that is can be turbocharged by what's happening with the broader tech industry.
So if the gross margin goes from 65 to 75% in 2 years, is that because of the AI efficiencies? Or was this the target they had before?
Yeah, that's just what's happening right now. It's just the scale of the business is just they've hit critical scale, and that's why the gross margins have been ramping already. They're doing a great job on cost controls where their expenses are rising a lot less than revenues, so their margins are going up. And it's just the scale of the business is that you're inflecting the profitability, and these models once you turn the corner on that, the earnings growth can be massive.
Well, everybody, let's put GWRE on the screens. I'm a tech analyst too, so I'm definitely going to do that. That's about all the time we have for today. I'm Paul, saying goodbye for the rest of the crew of Wall Street Beats, including Steve, Berna, Ben, Jeff, and Russell. We'll see you tomorrow.